Welcome back to the Personal Finance Project. Today we are continuing our segment on things you pretend to know by exploring the difference between mutual funds and ETFs. To kick things off, Greg, how is a mutual fund different from an ETF?
Well, mutual funds and ETFs are perhaps two of the most common investment vehicles that a person might make over the course of their, investing lifetime. And so while they can accomplish very similar things, you can invest in growth-oriented mutual funds or fixed income-oriented mutual funds, and the same in ETFs. The nature of that return is going to be slightly different based on which vehicle you find yourself in. Mutual funds are a little bit of an older vehicle, where ETFs are kind of the new kids on the block. And I think really the purpose of discussion here today is we'll get into some of the granular details of how they differ structurally, but then I think the more important element of what we're going to cover today is how these things should differ in the use case, how a person might use one. So I think the primary difference between the mutual fund and the ETF for the use case is generally how the composition of those returns are realized and taxed. And so if you own a mutual fund, this is an easy way to get broad diversification. There's generally some kind of front-end sales load charge unless you're in a no-load fund, or if you buy an A share at NAV, a lot of different granular details there, but you can get in relatively low minimum, broad diversification right away. ETF works much the same way. However, in a mutual fund, you send cash to the managers and they buy you shares of the mutual fund. And then if you want to get your cash out, you send the managers what's called a redemption request, and they send you cash back. You don't actually own the underlying shares of the mutual fund. You're just a investor. On the ETF, those actually trade like stock on an exchange. When you buy an ETF, you buy an actual share of the ETF. And if you want to redeem that ETF, you actually sell it on the open market. Go ahead.
Yeah, I was just going to add that. So a couple of things that are just very, very basic on this. Like you said, ETFs trade throughout the day. So if the New York Stock Exchange is open, you can buy and sell ETF shares. Most of the time, what's happening is when you, say, put in a buy order, you're buying it from another person, a share that has been in existence for some time, and you're just exchanging it like a share of stock. Even though it represents, if you want to think of it that way, maybe 50, 60, 100 companies, depending on the style of investing.
Right.
Now, historically, ETFs were very index-based.
Right.
So if we think back to maybe where we were 15, 20 years ago, if you were an ETF investor, it's very likely that those were, say, an S&P 500 index or a small mid or Russell 2000 index, smaller and medium-sized companies.
MSCI, like all those.
Yeah, so an international index. So the idea was, let's get really low costs by just mirroring something that is already in existence, as opposed to paying for professional management to go out and decide what is going to be in this stock or in this fund,
right,
so to speak.
And one of the cool elements of the ETF that was not available to their mutual fund counterparts was when the composition of the index would change, and they needed to then alter the composition of the underlying ETFs, the market tracking ETFs or the index tracking ETFs. What the government allowed the passive ETFs to do was called the in-kind redemption and creation, or in-kind redemption, I guess, and creation process here, where they could move things in and out of the ETF without actually having to sell something, and thus distribute those gains to the shareholders. So that was because some people get this element of the change of 2019 a little bit wrong. That process was actually afforded to active ETFs prior to the law change in 2019. But they had to apply for what was called exemptive relief, basically get an exemption from having to do that cash transaction process, which would allow them to do that exchange process, which was obviously quite beneficial because then you could defer tax.
Yeah, and essentially what's happening there is that exchange, what that's doing is allowing you to adjust or modify the allocation of the portfolio without it triggering true sales within, say, an omnibus account or an account that would have to or be required to flow distributions out to its shareholders.
Right.
And that is what happens with a lot of especially active managed mutual funds, is they have a couple really nice years in a row, and within this omnibus account where they're trading and receiving redemption requests. People are adding money into the fund. They are realizing gains and losses within there. And if you're having more good years than bad, eventually you're going to have to flow through some of those gains down to the shareholder level. Mm-hmm. With ETFs, like you're saying here, we are exchanging these positions outside of the fund. You're not realizing those gains over the course of time without actually transacting the shares.
Right. And the law change in 2019 that has led to we could call it an explosion of active ETFs, they essentially did away with the application for exempted relief. So now actively managed ETF can do that in-kind redemption or exchange process. And the other cool element of that is they can create what's called a custom basket of securities that they can exchange with an authorized participant. An authorized participant is generally like a large bank. So, JP Morgan, Bank of America, Citadel, these are authorized participants. They're an intermediary that is crucial to the creation and redemption process of the ETF shares. But the use case of that is when you have an active ETF, and I think a primary example of today might be, say your NVIDIA has really run, and now you're threatening or you're frustrating that bound of concentration that you're allowed to have in an ETF or a mutual fund, governed by the same set of rules, by the way. If you wanted to trim your position in NVIDIA, you could actually create a custom basket of securities within your ETF. And, conspicuously enough, that would include very low basis NVIDIA. And you could exchange those for essentially getting back shares of the ETF from the authorized participant. That is also not a taxable transaction. So essentially what the fund managers have done is they've taken a risk mitigation trade by trimming their position in NVIDIA, offloading their lower basis shares of NVIDIA to the authorized participant in exchange for ETF shares back. And that's not a taxable transaction that they're going to have to flow through to their shareholders, and they can remain in compliance for those concentration rules that are governing ETFs and mutual funds.
That is pretty in-depth there.
For the listener, I think in this segment where you want to disentangle these things, you can get really granular in the weeds. But I think where you and I come in the side of this equation that I like to sit on mostly is, what does that mean for the end user?
Yeah.
And I think from our perspective, because you've been ringing the bell on one thing that you're very passionate about, which is tax kind of optionality. And what that can mean is save some money in a taxable brokerage account, save some money in your traditional IRA or 401k, and maybe do some Roth so that when you get to retirement age, you've got a lot of flexibility. And the question has become, all right, Scott, I've got money in each of these three accounts. What sorts of things should I own there? And in a bygone era, you could maybe try to do individual stocks before mutual funds were available. And then when mutual funds became available, these were a really nice way for, sub ultra high net worth people to get immediate broad diversification. And then beyond 1975, with the late Jack Bogle's invention of the index fund, you could do that at extraordinarily low cost. So These sort of evolutions have been going on for some time. But then with the creation of the ETF, this is really where, for clients who go to your school, if you're going to be saving some money for long-term in your taxable brokerage account, the nature of your total return really matters. And what the ETF has allowed us to do in most instances, this isn't true for every single ETF, because you could have an ETF like that pays out a big dividend. Like, that's not unusual.
Yeah.
But if you want pure appreciation, this in-kind creation and redemption process and the custom basket process, all of those are just tools that the managers can use to very tax efficiently grow your money.
Yeah, and actually that provision is kind of interesting in terms of the ability to really defer gains as opposed to realizing them every step of the way. What it kind of does, and I was explaining this to somebody else, is, if you look at it, if you were investing in the 90s, it is very likely, I would say, that you have a non-qualified annuity. And the idea was, well, I want to invest in something and I don't want it to throw off a bunch of income or taxation over the course of time. Index mutual funds had not proliferated quite as much, so these annuities got really popular. What ETFs kind of do, not perfectly, but they allow you to do that very tax-deferred, growth-heavy style of investing, probably at a lower cost than buying into an annuity that has some of these guarantees on, say, like a death benefit or a return of principal benefit.
And the other nice thing too is, and you're exactly right, people were looking to in excess of what they were putting into their retirement accounts. And this was before 401k plans were widely adopted by a lot of employers too, 80s and 90s. And so they thought, I'm trying to create a lifetime income stream in my retirement. These non-qualified annuities seem like a really good deal because not only can I put some stuff in if it throws off dividends or capital gain distributions, I'm not taxed year over year, so I'm avoiding the tax drag. The bargain they made, though, was they turned all that appreciation that they had accumulated in that non-qualified annuity to ordinary income in the future.
Yes.
Because when they annuitize, you get the exclusion ratio, so you get your basis back tax-free, but a prorated share of every distribution you take from that annuity is going to be taxed to you as income. The protection they got, though, was pretty robust because a lot of these things, once you annuitized, they offered you a lifetime income stream you couldn't outlive. Some of them had a joint and survivor provision. Some of them had a period certain provision. And you're right, as you stacked on all these additional bells and whistles, they could get pretty expensive.
Mm-hmm.
The real beauty of the ETF for people who are maybe more of our vintage is if you can start saving fairly aggressively in a taxable brokerage account, you're going to be able to defer the lion's share of those gains, maybe until you're retired.
Yeah.
And not only that, you can take a loan against these assets at any point in time if you needed a bridge loan or were buying property. But more importantly, you're going to be able to exhibit an extreme degree of tax control because you can kind of manipulate your taxable income streams in retirement, particularly if you've got this optionality, to where you could take a huge advantage of the 0 and the 15% capital gains brackets.
And that's a really important distinction because I think a lot of times we'll talk like this and the thought process is, well, we are just vehemently opposed to capital gains. Capital gains are great. They're so great. Yeah, they're great.
Yeah.
They're so much better than ordinary income. And it means that the stuff that you're buying into has done well over time. What we're kind of focusing on here with the ETF versus mutual fund conversation is we like to be able to decide when we realize those gains. So like when you are saying your 50s and you're earning the most you're ever going to earn, if you're going to say retire in your early 60s, you know, your highest earning years will be those last 10 or 12 years before you retire in all likelihood. If you have big positions in an actively managed mutual fund, you get a year like 2024, you might have gotten an 8 or 9% capital gain distribution flowed out to you on top of your highest earning year. In an ETF, you did not get that distribution. You have a more concentrated capital gain. Say you retire in 2026, you start to pair off some gains by selling from the position. And that's a lot more tax efficient because you have a lot less income in 2026 than 2024 in this example.
Exactly. And I think that's exactly right. When you have the ability to be the agent of, you know, when you want to realize gains and in what amount, not to mention for tax planning purposes, the year-end cap gains distributions can be somewhat of a headache because while they're not totally random in their timing, they generally pay about the same time every year, they're somewhat random in their amounts. Because we also had an issue in 2022 where opposite effect in the market, you're talking about your shares are decreasing in value, but because of perhaps redemption requests and other such things, not only did you lose a lot of your underlying value of the fund, you might have had to pay cap gains on a distribution
because they're liquidating things within the fund to pay out
other investors.
Yeah, other investors who are leaving.
Yeah, and so the other structural advantage that the ETFs generally have, and this might not be true of all of them, kind of depends on how robust the options market is you can do calls and puts on ETFs.
You can do limit orders.
You can do limit orders on ETFs because they trade like a stock. I don't know if whatever is afforded to a stock is afforded to an ETF, but these are things that are absolutely not afforded to mutual funds because remember, when you own the mutual fund, you really just own a share of this actively managed pool, whereas when you own the ETF, you actually own your own you own those ETF units, which allows you to play options games on them. I'm not suggesting that people do that.
Yeah.
It's just another consideration.
Yeah, and I think another thing that you consider, and this is, I want to caution before I jump into this and say, day-to-day changes and whether you get in, say, at 9 o'clock a.m. or 3 o'clock p.m. on trade, over the long run, it's going to have very, very little impact on your investing success or failure.
If anything, you'll harm yourself.
Yeah, probably trying to time those types of things. But I would say one instance where you maybe could argue that ETF has an additional benefit over mutual fund is, say, you're worried about something, or you decide that you need some money for a trip and you're selling on a day where the market does quite poorly. If with an ETF, if you sell at 9 a.m. when the market's down 300 points, that is the price that you get on all of those shares. If you do the same thing with a mutual fund, and then, there's a run on a bank at 11, and then there's more tariffs that come out, to use a current example, that scare the market at 1, and we close down 1,200 points. In a mutual fund, you're participating in all of that downdraft throughout the day.
Yeah, and because you can put your redemption requests in for the mutual fund any time of the day, they just trade once a day at the end of the day.
Yes.
That's it. So that's the price that you get. And we were talking, off microphone, I suppose, before about how a lot of people confuse the regulatory environment in which ETFs and mutual funds have to play. And a lot of people, because ETFs are deemed to be somewhat newer vehicles, think that they're not governed by the same sets of rules. And that's not true. So the concentration requirements that mutual funds have are the same for the ETF. All of the things that are, I think, in it's the investment advisor, is it the whatever the one in the 1941? It's the investment
40
advisor.
Act.
Yeah, the 40 Act. So the funds and the ETFs are governed by those rules. So there's no really special provision within how the managers can own various companies and in what concentration they can own them that are giving ETFs a leg up performance-wise. And not all ETFs outperform their mutual fund counterparts. Just want to state that plainly. But I think that, at least in our experience, when we do see that outperformance, it doesn't shock us that much, because if you had a manager who's, demonstrated some skill with picking some stocks and knowing when to buy and sell some stuff, and certainly there are companies who do that, if they can do so in a way that where they don't have to think about the tax impact, I think that's really going to be the variable that's explaining some of the delta between, say, an actively managed ETF and a mutual fund counterpart.
Yeah, and I think we've talked about this a little bit with clients in the past, is if you want to talk about, an actively managed mutual fund that has done really, really well, what tends to happen is you end up, say, on a Morningstar 5-star list, or you get a gold rating, or people see that you did a really positive year. You beat the market in, say, 2019. Well, you start to get tons and tons of inflows, which leads you to maybe have to make a lot of purchases to keep the fund fully invested. ETFs, you don't have to do that. If you get really, really popular, you're just creating more ETF units. Yeah, you're buying into securities at a higher market position, maybe,
sure,
but you're not having to deploy a lot of new capital at a time when maybe you've done really, really well recently.
Right. And also the ability just to trim over time.
Yeah.
Is you accumulate all these positions because you think, all right, I've got some new money. I want to add to some of these positions, but I'm overweight at NVIDIA. I'm overweight Meta, but I can't really get out of it, because if I sell it, then I have to flow this big gain down to my shareholder. So rather, I'm essentially having to construct a portfolio for this new shareholder from whole cloth out of this cash that they sent me, as opposed to in the ETF, it's like, I already got these ETF shares and they're just buying into whatever's there, as opposed to just that pure cash exchange process in the mutual fund. Now, this is not meant to be a podcast that you come away with it saying, I should never own a mutual fund ever again.
No.
And I think there are some places where it makes a whole lot of sense to own a mutual fund.
Yes.
If you're owning mutual funds in your 401k plan, you probably can't yet own ETFs in your 401k plan. That might not be a provision that exists forever, but I'd imagine right now, mutual funds are a great vehicle in 401k plan, because 401k IRA, even a Roth IRA, you can be indifferent to the nature of the return. You're just optimizing for either, setting up an allocation that maps your risk, or in like a Roth IRA, you just want maximum total return. Doesn't really matter how you get it.
Yeah.
It doesn't need to be tax efficient. So there are still plenty of cases where a mutual fund will make a lot of sense.
Yeah, I would say generally, I kind of like the idea of the higher something's going to pay as a dividend. Maybe I start leaning a little bit more towards mutual fund in that structure, because we know that they have the potential for these capital gain distributions. So why don't we just smooth out that reinvestment stream a little bit by investing in something that's going to pay out dividends? We know that's going to be the case.
Right.
And then we're just kind of saying adding a little bit every quarter or every month to this position. Like you said, also IRA, 401k, Roth IRA, if you get a 12% capital gain distribution in December, it doesn't matter. You either can decide you want to put it into something else, or you just turn on automatic reinvestment. That is maybe one thing you could say is a small detriment to ETFs is, say you want to generate exactly $1,000 in your account. Mutual funds, you can do that. ETFs, you have to find the corresponding number of shares that gets close. You have to put that order in and during the course of the day.
And it makes automation of that process almost impossible.
Yeah.
Because for the retired investor, particularly a retired investor who's in RMD, having big year-end cap gains distributions when they're making mandatory distributions, withholding payments, and maybe qualified charitable distributions, having a part of your return come into the account as cash
in December
is preferable in many instances, especially if you're just going to go ahead and spend it. And the other thing that most of our clients who are in retirement do is they have a systematic monthly sell of one of their underlying funds where we generate a specific dollar amount in cash for them and then distribute that later. That's not yet possible with an ETF because, as you said, giving an advisor time and price discretion on that and trying to automate it, basically saying, sell however much shares you need to get $1,000, almost impossible to do with an ETF.
Yeah, and because if you put in, say, all right, you need to, as of today, you need to sell 50 shares of this thing to generate $1,000. Well, next month it might be 48, and the month after 52. So if you're always selling 50 shares, which could be automated, you're not going to get the same amount.
You're not going to get the same dollar amount.
Yeah.
So it turns into from a very precise tool to a very blunt tool. So yes, you have intraday liquidity, and that's great. You can trade anytime you want. But as you pointed out, I think that benefit is probably overstated and maybe harmful, especially if you're the one who's trying to play the market. As today would be a great example of trying to play the market. You could really hurt yourself. So I think the crux of the conversation on things that you pretend to know, ETFs versus mutual funds, for my money, an investor can have 90 to 99% of all of this knowledge. But if they just had one takeaway, which was where to own these specific things, they would get the maximum benefit out of this whole episode.
Yeah. And I would say, to add on to that, these things are more similar than they are different.
Right.
And so if you are a new investor thinking about putting $1,000 into the market or into an investment, choosing one over the other, if they're both low cost and there's not a big commission on them, go ahead. It's not going to be a huge problem. But over time, especially as you grow your assets, the thing we would caution is probably ETFs in a taxable account, mutual funds, a little bit better a fit for an IRA or a 401k.
This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value. This broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.